Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. Thanks to Policygenius for sponsoring this video, but more on that later. If you're new to personal finance, investing, or would just like to know a better way to manage your money, you are definitely watching the right video. In this video, I'm going to give you a 5-step framework to follow on how you should invest your money and even more broadly, manage your money properly for the long term. Let's get into it. Okay, number one is that your money needs a purpose. You need to have goals for your money. By now, you probably know that you need to invest, but how are you going to do that properly if you have no idea what you're even investing for? Giving your money short-term and long-term goals allows you to stay disciplined and focused on why you're even investing or managing money in the first place. Let's start with long-term goals. Long-term goals, in my opinion, are things that you can save for that are at least 5 years away, but in most cases, these examples may even be 10 years and longer. So most people's long-term goal is to have a healthy and financially comfortable retirement, for example, but there are other long-term goals as well. Do you want a dream home in the future? Well, you can start saving and investing for the down payment on that home. Do you want to take an extended vacation overseas? What about a potential vacation home to invest in time with your family? Figure out what you really want later in life and set it up as a goal for your money to work towards. Let's take a look at some short-term goals. These are typically less than 5 years. Every year, my wife and I make a list of business and personal goals that we would like to achieve. My goals for the year are broken down into 3 categories. They're usually travel, finance, and fitness. These are things that are important to me and they are just examples. If you have things that are more important to you, you can break down your short-term goals into different categories as well. So within my travel goals, I usually have a beach destination, a European destination, and one new destination that my wife and I have never been to, so a new place. Within my finance goals, I typically look to add more to my savings and emergency fund, add some money into our house fund for different projects that may come up, funding my daughter's 529 plan, buying more Bitcoin, obviously, and then adding to my taxable stock accounts. So you can use these examples as a framework to create your own long-term and short-term goals. Therefore giving your money a purpose and something to stay focused on. Step number 2 is understanding if you need to hire a professional. Do you need someone? Should you work with someone? Number 2 is deciding if you would like to work with a financial professional or not. Once you've established your short-term and long-term goals, you can dive into the specifics of how you actually want to save and invest your money. This is where a lot of people think that investing is complicated. It's not complicated. It could be intimidating, could be complicated, which, it all depends on the type of investing you want to do. For the everyday person, I always recommend investing in index funds and ETFs for the long run while diversifying the rest of your portfolio into other assets such as real estate, bonds, cash, precious metals, and some cryptocurrencies, specifically Bitcoin. If you are still intimidated by all of this, there are a few different routes you can go for choosing help. You can work with a financial advisor who is a human, or you can even go the robo-advisor route. Robo-advisors are typically online advisors that use algorithms and software to understand how much risk you're willing to take and then automatically invest in assets to achieve that risk profile. Both of these are viable options, but keep in mind that this will be more expensive than you managing your own investments. If you're looking for examples of portfolios, I have videos on the lazy portfolio, the all-weather portfolio, and many others. Just take a look at my channel history. This will cover a lot of your bases and keep you well diversified should you choose to go your own route. But keep in mind that investing is all about being compensated for the amount of risk you are taking. Someone who is 21 years old and single will have a much different risk profile or risk tolerance compared to someone who's getting ready for retirement. If you're looking for a simple 3-fund portfolio, a quick example would be creating a pie of 60% US stocks, 20% international stocks, and 20% US bonds. I'm not personally investing heavily into bonds at this point in time, but that's outside the scope of this video. Number 3 is picking your investment account type, aka your investment vehicle. So choose your vehicle, that's a car. And notice how we actually have an internal combustion engine car, okay? We're not giving into the EV trend just yet on this channel, okay? So this is not a car. This is just a type of account that your investments will live inside of. So in order to buy most stocks and bonds, you're going to need a brokerage account somewhere. This is the same as if you wanted to keep your money at a bank. You can open up a checking account, a savings account, a money market account, a CD, any different type of account. This is no different, okay? However, this is just choosing the type of account that your investing funds will live in. So here are a few examples of investment accounts. Most of you watching this video video have heard of a 401k. This is offered by tons of employers that take money out from your paycheck and automatically invest that into the 401k plan that you have set up with them. The beauty of the 401k is that most employers will actually match your contributions up to a certain percentage. So for example, someone's company may match 100% of their contribution up to 6% of their salary, for example. Sometimes it's 3% and 50%, it just depends. If your company offers this, I would recommend that you contribute up to the guaranteed match. This is effectively free money in simple terms. 401ks also reduce your taxable liability for the year, but what you will be taxable on is when you actually go to take that money out upon retirement age, so keep that in mind. The next example is a traditional or a Roth IRA. IRA stands for individual retirement account. I prefer to discuss the Roth IRA specifically. If you're gonna contribute to a 401k as well, a Roth IRA is different than a 401k because with the 401k, you're contributing pre-tax dollars, okay? That's getting a tax advantage for that year. A Roth IRA is the exact opposite. You're contributing to a Roth using after-tax dollars or net income that you've already paid taxes on. The beauty of the Roth is that this money will grow tax-free and will no longer be taxed because you've already contributed with after-tax money. Make sense? The next example is a taxable brokerage. So I have examples of this using M1 Finance. If you want to get my free M1 Finance training link to show you how to use that platform and show you how I invest hundreds of thousands of dollars, you can do so in the description below. A taxable account is simply an account that isn't related to retirement and not tax advantaged. There are no rules regarding contribution amounts, so how the money in these accounts is managed is completely at your discretion. Most taxable accounts these days allow you to borrow against them at a low interest rate, adding another weapon to your investing arsenal down the road. However, these are subject to short-term and long-term capital gains tax, depending if you make money or lose money using this taxable account for your own trades. So I would advise that you first take advantage of all the tax-advantaged accounts, such as a 401k and a Roth IRA, before starting to beef up your taxable account. And finally, we have college savings accounts. This is another way tax advantage accounts work for your child. These are typically known as a 529 plan or a 529 account. There's also a Coverdell education savings account, which I'm not going to talk about in this video. I personally have a 529 plan for my daughter. Depending on the state that you're in, you're able to reduce your taxable liability by a few $1,000s per year based on the contributions that you make to this account. Also, if used for educational purposes, the money that grows in this account is tax-free. This means that all of the earned income is yours to use, and you can, as long as you use it for a qualified college cost, okay? So over the course of 18 years or so, when your child will most likely use this account, that could be a huge amount because of compounding interest. So speaking of planning, college, and children, let's get into today's sponsor of Policygenius. Whether you're graduating from school, planning a wedding, welcoming a baby, or switching jobs, now is the time to get the insurance coverage to protect your family's finances during the next big phase of your life and beyond. Even if you have coverage through your job, that may not be enough. Most people need 10x the life insurance that their company provides. Having the right coverage can give you peace of mind that your loved ones are secure if something happens to you. Policygenius is your one-stop shop for finding and buying the insurance you need. Getting started is simple. Just click the link in the description or head to policygenius.com/whiteboardfinance and answer a few questions about yourself. Their proprietary technology makes it easy to save. In minutes, you can compare personalized quotes from top companies to find the lowest price and coverage you need. You could save 50% or more on life insurance by comparing quotes with Policygenius. Their team of licensed experts will help you understand your options and ensure you apply for the right policy. Policygenius works for you, not the insurance companies, so you can trust them to offer unbiased advice and help you navigate every step of the shopping and buying process. When you're ready to apply, the Policygenius team will handle the paperwork and scheduling for free. Head to policygenius.com/whiteboardfinance to get your free life insurance quotes and see how much you could save. Step number 4 to managing your money and how to invest is number 4, opening the account. Now that you've researched the types of accounts that are available and the benefits that each one of them provides, it's now time to open one of these accounts, or a few of them if you're going to open up a 401k, a Roth, and a taxable account. So when choosing a brokerage or an account provider that I like to go with, I look for a long-term track record. When I was in my early 20s, I opened up a Vanguard account for my Roth IRA. When I was 18 years old, I opened up a taxable account with Trade King because the trades were only $4.95 a trade, which isn't the best reason to go with a company, okay? The reason I bring this up is because there are a lot of fintech companies out there that will give you free trades, which most brokerages do now. However, these companies, a lot of them are literally less than 5 years old. If I'm gonna be saving for many, many, many years, or if not decades, I wanna go with a company that has been around for a long time. Most brokerages are online and they will allow you to self-manage your account where you can buy and sell a bunch of different investments, such as stocks, bonds, and other things. I would go the online broker route if you are someone who wants to make your own investments on your own time. This is personally what I've done since I was 18 years old, and now I'm 34 at the time of this recording. My taxable account, my SEP IRA, and my income portfolio are all on M1 Finance. Again, you can get my free M1 Finance training down in the description below. My Roth IRA is still with Vanguard to this day, and I use other platforms to invest in crowd-funded real estate, but that's outside the scope of this video. If you are still intimidated by managing your own investments, we can go with the robo-advisor route, which I mentioned earlier in this video. There are many robo-advisors out there to choose from, such as Wealthfront, Betterment, Personal Capital. They're not sponsors of this video, but those are some of the original players in the robo-advisor space. All right, number 5 is invest to Swan. So that's supposed to be a swan. I wasn't gonna leave this in, but it's funny. I don't know what I know what a swan looks like in my mind, but this is what it comes out when I draw. This looks like a radioactive swan. Anyway, so invest to Swan. So what does that mean? Swan stands for sleep well at night, okay? Sleep well at night. So here's a perfect example. If you are 21 years old, you have years to allow for your investments to compound and earn you money. This allows you to be more risky earlier on in life when you have fewer responsibilities and dependence. With higher risk typically comes higher reward. This is why your savings account pays you so little in interest, because it's an almost guaranteed rate of return. The reason venture capitalists are compensated exponentially more than people who are risk averse is because they're failing 99 times to hit that one home run out of 100. The way I break down my investments is like thinking of a pie with slices. So here, if you picture just a big pizza pie, here's a bunch of slices, okay? So I'm okay with 30% of my net worth being in stocks. I'm okay with 40% of my net worth being in real estate. I'm okay with 15% of my net worth being in cryptocurrencies. The reason for this is because if any of these slices of this pie were to go to 0, that is the risk tolerance that I'm willing to take on that. So let's go over some options or slices to speak on that you can invest in. So the first options are stocks. These are individual shares of companies that you believe will increase in value over time. This is like someone saying that they invested in Microsoft, Google, Tesla, etc. Individual stocks are okay, but I personally wouldn't have them make up a significant portion of my portfolio or net worth. You don't want all of your eggs in one basket. The second option are index funds and ETFs. These are simply baskets full of stocks that are designed to mimic or track a certain index or investment type. This allows you to buy one share, but have hundreds, if not thousands of companies make up that one share. So think of an Easter basket. I'm not even gonna draw an Easter basket right now, full of different eggs that are a bunch of different colors. These represent individual companies, but the Easter basket is one share of that index fund or ETF. Make sense? So a good example is a good index fund such as VTI. This is a great one for beginners. You're just betting that the stock market will go up over time. This is Vanguard's Total Stock Market Index Fund. One share of VTI contains over 4,000 publicly traded companies in it. The third option are bonds. Bonds allow a government or company to borrow your money to fund a project or to refinance other debt. These are typically considered fixed income investments, which make regular payments to the people that invest in them. Your original investment amount, aka your principal, is then returned on a set maturity date. Bonds have historically been less risky than stocks, so this has typically been used to balance out a portfolio, as mentioned earlier, such as the 60-40 portfolio, 60% stocks, 40% bonds. We talked about this earlier. And your fourth option is obviously real estate. Real estate is a great way to diversify your portfolio as an alternative investment. So you're asking yourself, hey, Marco, how can I invest in real estate? Don't I have to physically buy a rental property or an apartment building, for example? Well, you can do this, but through the stock market, aka the equity market, by investing through what we call REITs, which stand for Real Estate Investment Trusts. I'll write this down because I know it's kind of hard to hear. REIT, R-E-I-T, Real Estate Investment Trust. They essentially act like stocks, but for commercial real estate. So typically commercial real estate. So REITs typically pay high dividends, and they're a great way to diversify a portfolio. I personally hold REIT ETFs in my dividend portfolio. If you are the 21-year-old with no dependents and have a high risk tolerance, you're gonna wanna invest a majority of your portfolio in stocks. If you have a low risk tolerance or are nearing retirement or are getting older, you'll want a portfolio that is more bond heavy and less volatile. There are a lot of factors that are making bonds unattractive right now at the time of this recording, but that's outside the scope of this video. Whichever route you choose, let's go back to step one and remember why you're investing in the first place. Think about your long-term goals and not trying to 100x your money through some crypto scam. Think long-term. The last thing I'll leave you with is what I just mentioned a minute ago. Think of your net worth as a pie. Each slice should be a different asset class, and each slice should have a certain weighting in your portfolio. So I hope this video was helpful to everyone who watched. Be sure to check out the links in the description below. And as always, have a prosperous day. Oh my God, this drawing is so bad. All right, so think of each one of these slices. I'm gonna get rid of this so I can actually make this bigger. I should have elaborated this more in the video. If your pie looks like this, okay, here's your cash. Remember, this is just a percentage of your net worth. And this is butt floss coin, making up 98% of your portfolio. This isn't good, okay? Make sure butt floss coin is not 98% of your portfolio. If I'm using this as a joke, but I'm serious. If you're gonna invest in speculative stuff, keep it to like 5% of your net worth. That's the stuff you should really gamble on. Everything else should be solid investments. Hope this makes sense. Thank you guys. Little do they know, I made 40 G's on butt floss coin, baby. Let's go.